On this episode of Flux News Show, I'm in Singapore, but with the guys still in the studio, and this is all about digesting the OPEC news and the fallout from it, the volatility from it, and now looking at what we think are dislocated market numbers and potential great trades to get involved in. As always, we have all the sections to go through the market very thoroughly, and I hope you enjoy. Okay, straight into the temperature check.
Cool. So overall, the temperature check market's been warm, so less hot than before. But there's been a lot of things happening, especially with regards to the OPEC news. So flat price saw a huge sell-off, down by $5 on the week, opened below 60. That's Brent on Monday morning. So that was a huge one. Spread sold off as well. Brent and contango from October 2025 onwards. However, the weakness in crude has been offset by continued strength in the margins, especially in gasoline cracks. So there's been a lot of bull, a lot of bear. Also Brent Dubai, that's seen a volatility spike and it's come off as well. So there's no shortage of topics to talk about, but there's definitely been a bit more of a risk-off market. So trading volumes down by 15% in Brent and WTI, but the volatility or the headlines or the drama is still there.
Yeah, I think we need to just recap obviously the events, because it was a big hyped up meeting, and I guess what was unusual was how aggressively the market was reacting to the OPEC news or OPEC meeting ahead of time, right? So since our last podcast, people were essentially taking it as a given that there was going to be 400,000 barrels per day increase. It didn't feel like a rumor; it felt like certainty. And on top of that, it felt like it was almost like the market was just starting to price in a price war. And so, really, when that happens, right, we get an element of that being priced in people's psychology. So anything that isn't that is bullish, and that's effectively what happened, right? We had not as much of a price war situation because the Saudis OSP, I guess you could argue, didn't come in lower, which would be signifying a price war. And also, as we just said, as I just said, it was kind of expected. So we did get an initial sell-off, as I discussed it on the weekend and on the open, but it's drifted all the way back up. And we're now on a little bit of a bull run here. The Brent spreads have started to perform again. Gasoline might be weaker, but generally speaking, with flat price being higher, it seems like the market's almost maybe finding its feet again towards the upside. It's certainly doesn't feel like a big dramatic thing. And I guess to round that off, the volatility seems to come off quite a bit as well. And that's basically how we'd summarize it. Anything else to add on that, Harry?
I think one thing might be good to discuss is, so you saw an initial rally on Brent Dubai on this news, but even as of this morning, the front end of Brent Dubai has come off quite a lot. I thought it might be quite good to just discuss why we think that might have happened. So it's kind of could be expected that the back end Brent Dubai could be rallying more in anticipation of kind of further production increases. But do you have kind of a hypothesis as to why the front has kind of rallied and then cooled all the way back down? I mean, it's basically trading around flat again this morning.
I mean, I think first off, I mean, we should get the chart up. I mean, Vincent, you can do that as I'm talking, but ultimately, the whole Brent Dubai curve was starting to shift aggressively higher. So last week, going back to what I was saying about people reacting to the news, to the meeting before it had been announced with such high conviction, I think the main signal for that was Brent Dubai, right? So we had, as this graph shows, this is was this June? Yeah. So this is the front month Brent Dubai. Come on, this is an enormous rally, and a dollar almost $2 rally in a couple of weeks is a big move for Brent Dubai. I mean, very big move. So I think this was probably a lot of scrambling for the exit from a lot of players that we know were short. We know the market was heavily short. We know the open interest was actually very high. So I think I know actually from rumors, but I guess you can see from the data as well that there's probably quite a few people called out on this. And then when the news came in, and it wasn't quite as dramatic as people thought, because I think the whole rhetoric from Saudi was like, look, we are increasing more, but we're not actually increasing that much compared to our limits from before, and this is more about getting people in line. This is a signal that if they don't get in line, we're gonna really start the price war. So I think that retracement back, not a lot traded on that retracement. So if you could just imagine a really short market, and everyone clamoring to buy at once, the market shouldn't have got itself in that state, right? It shouldn't have got itself to too short, so close to an OPEC meeting. It's so close to an unraveling. But I think that's the very nature of a market being perpetually short that contract for so long. OPEC have been cutting for 5+ years now. So I guess it has always made sense for this trajectory to be heading kind of generally south in Brent Dubai. So a complete reversal of that, I think, is just caught the market unawares, and I think the market has to take blame for that, right? Nothing can last forever, especially with something like swing production, like from Saudis and the OPEC. So anyway, my point is that when you have this highly overly short saturated market, the high volatility in the breakout makes sense, and then you're scrambling to buy if you're short, or you're just buying new as if you're a new entrant. And we got a big volatility spike. These moves are huge. But then if you are short, what are you going to do, right? Are you just going to go, if you're a huge trade house and you've got huge positions, like 50,000 lots plus, you're not just going to join in when it's the most volatile and just lift every offer. If any trader who's been in that position, having to manage a big position that's not going your way, it's a horrible, horrible feeling. And it's a horrible thing to manage, because you will only exacerbate it. And then once rumors get out that you're in pain and people kind of know your position, which they do generally know in the oil market, then they can make it even worse when they see large volumes going through and it's more obvious that people are stopping out. So the best thing to do in some respects is when it's peak dramatic and it's peak kind of people unraveling their positions, like it was kind of like Wednesday, Thursday, it's best just to hold back, right? I mean, this was even the case with the Saudi attacks in 2019. Flat price opened $10 higher on the weekend, on the Sunday evening. And there were some people who were long, but there were some people obviously caught short. But because it was such a dramatic move, and it was like it was peak uncertainty at open, and people were waiting to see how the markets took it, it kind of drifted all the way back after that, like days later, which kind of makes sense, because you're always going to have your biggest move at the peak uncertainty. And as things start to come into more focus and people have more of an idea of what's really going on, it's not quite as bad maybe, or at least people can start to figure out what this really means. That tends to be a little less dramatic in the markets. Now, I would just summarize it as that, like a huge blowout. These huge shorts aren't just going to chase it all the way up. They probably think, look, I'm better off selling this continuously into pricing and pricing off rather than having to buy it all back. And let me just wait and see what happens. And it was probably the right move, because it has now retraced back on very low volume, which says to me, basically, it's still a very short market from some of these big players. It's now broke out this range, so I still think we've set a new north trajectory on Brent Dubai. I think this is a long-term structural change, but it's going to be choppy in between. So if you weren't in kind of Wednesday, Thursday, and riding this initial move, it's a pretty bad time to be chasing the highs. If you're buying, you kind of need to let it settle down, like it is starting to today, and maybe kind of waiting for the volatility to die out a bit before maybe entering. And that's kind of how I'd summarize it.
Okay. Yeah.
So, I mean, what else is there to say? I mean, we've got the OPEC meeting very much was in focus, but there's the refinery margins, like I think Vincent mentioned at the beginning, still very strong. We've had talk about refinery utilization being announced by certain companies, but actually, what is strange is that there seems to be reports that people aren't going to be or refiners aren't going to be ramping up as much as we would expect. They should be at 100% if they can be. I think Repsol announced they weren't going to be going gung ho, and I think Marathon are at 94%, which is big, but there's more in the tank there. But I guess their thinking might be, we've been here before where we ramp up to maximum rates, and that's when it leads to outages, fires, maintenance issues, which can be really damaging and cause huge volatility in the market. So I thought that was interesting as well. So I guess that kind of means that the product crack levels can sustain, at least from a fundamental basis, where they are right now. And we're in a bit of an interesting market now, because we've reset from the OPEC meeting. That's now behind us, and we're now looking forward. And even the tariff situation is probably going to come back into focus, and the macro situation in general. So it's a bit of a breather, I would say. Yeah, that's a fair point.
Yeah, I would agree. When we were discussing yesterday, it did feel like that. You've had like a big gasoline rally, margins are still strong. So yeah, it's kind of like, what's the next move? Where's the next like direction, and what products it's going to happen in? Because we've been saying for a few weeks now about the gasoline rally. Naphtha's starting to get dragged up. Fuel's still strong. It's feels like it is in a bit of a breather.
And that's I think now you've had that peak volatility, peak uncertainty. I mean, everything that could be thrown in the market has been thrown in the market, like a huge macro event, then an OPEC meeting. You've now can take a breather and look what's out of whack. And I think the intelligent traders are going to start looking at, right now it's settled and now volatility's died down a bit. What are the normalization trades? Now that we've got a good sense of what's going to happen for the rest of the year, what are the right trades now? Probably a few days off, like relatively high conviction trades coming in, but I think that's what's going to kind of, the market's going to go through the gears, I think, from here on out. So if I was giving advice to traders, I would just be patient, start to look at these things, and like you just mentioned, naphtha getting dragged up, and it was again like people were finding it hard to explain some of these moves, but that's now coming back down as well. So I think volatility lowering and normalization is kind of the theme, I would say, right now. So let's, I guess that's quite logical to go to the herd mentality.
Yeah, of course. So for herd mentality, what we penciled in was also about OPEC as well, which was quite unsurprising. That was all the market could talk about. There was a lot of discussion, a lot of rumors about whether or not there was going to be a price war. But as we saw over the weekend, with the market seems to have priced us in, they have reset. But also with the higher than expected OSPs as well, Saudis are raising them, indicating that there wasn't much appetite for a price war, and so the market seemed to have normalized a little bit. But it is interesting to see. I saw the Saudi production figures that they were, of course, shouldering much of the voluntary cut, 1 million barrels per day, so much so that their production, I think, down to 9 million barrels per day, was actually lower than the peak COVID levels, whereas the shale oil producers just kept on producing, going into all-time highs. So there's definitely a bit of this market share discussion as well. That's been very talked up by journalists and the lots.
It's worth it might be worth saying as well, just for the viewers, and Greg did touch on it earlier about the OPEC cuts aren't always as black and white. When you see the increases, when you see it's 411,000 barrels a day, that doesn't mean that it's necessarily 411,000 barrels a day of additional production, right? Like, part of the whole market digesting this is where's this additional production coming from? Is it just like compliance? Is it increasing quotas for some people? Like what's the actual like net amount of additional barrels in the market? And that's probably why you've had some of this it's definitely why you've had some of this volatility. But yeah, I thought it was worth explaining just for the viewers. It's not always as black and white as just
because the officials guys did a video on this cuts. It's well worth going listening to that. It's already got like 1,500 views. It's done like really, really well. They're great at explaining the landscape there. That's worth looking at if you haven't already, because it is quite a nuanced thing, but it speaks to the psychology of these players and to the market. So you're absolutely right. Looking at a cut and just thinking binary, bullish, bearish, it's not. You got to look at it like any trading, right? Like if you're wanting to buy, but a market's already done all the buying from an open interest perspective, right? Everyone who can buy has already bought. It's a bad time to buy, even if there is bullish news, and that's the same thing with macro headlines, with OPEC headlines. You've got to look at the state of the market and then the news combined. So like I was saying before last week, everyone was talking about it like it was a given, and the market had reacted. So if you'd seen the market being tentative, then it's basically a good sign that the market is a bit not wanting to take the risk. So when the news comes in, that is a good time to be high conviction. But this was the complete opposite. This was look, the market's reacting quite aggressively. We know the hedge funds were getting short. we know speculatively, we know there was like actually quite a lot of conviction, generally speaking, from macro players about like expecting this price war. We were hearing like it feels like people were actually quite greedy in this scenario, like wanting to make money out of this. And the Brent Dubai was making some really aggressive moves really early. So then when you get something that is a bit more nuanced, like almost by definition, it's bullish because you've priced in so much bearishness and you've priced in a big market reaction. The only way it can go now is, oh, maybe it's not so bad. Maybe I should actually unwind that trade a little bit or de-risk a little bit. So the de-risk trade was weirdly buying, right? And I guess we've seen that from like a $3, $4 rally in flat price already, just since Sunday night, which is a bit of a weird scenario, but it's a good reminder for traders. You can't just look at things in isolation and say bullish, bearish. You have to say bullish, bearish information against the market state. And I think that's something we need to like continuously talk about as we go on. And that's what we're trying to do, right? We want to be forward looking. So when we say the herd mentality, I think it's useful to say this section's great to be like, look, generally speaking, when the market likes to react to one thing at a time. So what headline is driving the market? So last year, towards the end of last year, it was all about the Israel-Gaza scenario. Like, if you notice now, the oil markets do not react. And last year, it was so sensitive to any headlines, any escalation. And there's all these theories as to why, but it doesn't really matter, right? At the end of the day, you just need to know what people are reacting to. And then you need to start to realize when people stop reacting to it, because then you might do something like, oh, that's another bullish headline. Oh, I'm going to buy. Whereas like, well, the market's stopped. It's got fatigue on that headline and they've moved to the next one. So if you think about this going forward, of course, last week, like Vincent said, was OPEC as expected. What do we think going now is the market's going to be sensitive to? I mean, I would say even the tariffs with China come back into the table, and there's a bit of walking down on this tariff situation, but the market isn't really responsive to that, or is it? I mean, maybe that could justify some of the bullish reaction from the macro leading into oil. I mean, what do you guys think going forward the market is going to be sensitive to from a headline point of view?
Yeah, I like 100% tell you what you say. The market moves on so quickly from news articles, and if the OPEC meetings happen now, it's kind of like, well, what's there left to say in the short term? But yeah, I guess, I mean, yeah, if people have been bored of tariff chat for a while, maybe that starts to become like in vogue again. I mean, the US-Iran deal as well, but I don't know. I mean, people have been talking about that for donkey's years. So yeah, it's like it's quite hard to get to cause like where's there less headline fatigue, because all of them have been like dragged out so much.
But I think that's a good answer, right? I honestly think that there is headline fatigue on all these things. So actually, there probably isn't going to be much volatility from headlines, which I think the market will appreciate, because it's been a rocky ride, and it's been pretty nuts from a headline basis, which is not always the case in oil markets. So if people aren't going to be so sensitive to headlines now, then that can allow the real market, if you like, the underlying oil market, the physical and the industry players, to start to shape it outside of the macro money, which I think is something that the industry likes, right? They obviously like to be in control of the market, and when they do something, they don't want financial money overwhelming something they believe to be a fundamental or physical related move. So I think I actually agree with that. So the herd mentality is maybe like actually kind of dying out from a headline basis, and maybe leading to more physical signals. So that's things like maybe storage stats people are going to be more sensitive to, because the talk has been that storage is actually on the low side, despite all this talk about builds and despite all this talk about supply and demand being out of whack. The actual storage is relatively low on a 5-year historical basis. So it'll probably be sensitive to that, probably be sensitive to refinery margins. And I wonder now if one of the main trades, and certainly one of the main normalization trades, is probably selling the refinery margins. I mean, they are strong, but are they not just strong off the back of a few different kind of relatively crazy things? I mean, we talked about at the beginning of the year, the fuel oil cracks, right? The fuel oil versus Brent being positive, which is just kind of unheard of or unusual. And it's sustained that. The diesel cracks are very high for a market that's meant to be kind of in a low demand period. So maybe everything's just been dragged out of whack because of all the mentalness. And, it shouldn't sustain there if refiners are making as much as they're making, and demand isn't quite there. So that would be my first thought, is that these margins, we should probably start focusing on it, and maybe the market is too. So it's not really a headline, but I would say maybe that answers the question. I don't know, Vincent, if you've got anything to add to that.
I think it's more, yeah, I guess to your point, it's more oil focused rather than macro focused, which I guess people are quite fatigued about all of these tariff headlines. And to be fair, though, there was an announcement since last night that US and China were going to hold trade talks in Geneva this weekend, which is the first major development after the initial escalation between the tariff wars, which does signal the first step to de-escalation, which both sides want, but they want it in a way that both sides can save face. So that's a start. But something I would wanted to point out was an interesting one that FEICP was quite heavily affected by the initial headlines with the tariffs, especially when China imposed the tariffs on the US, which essentially meant that they would essentially be unable to import much of the US propane. But within the LPG market, talking with traders, they've mentioned that there's been wide expectations that these tariffs there'll be exemptions for propane in addition to, I think, ethylene, in addition to ethylene. So, but looking at the FEICP forward curve, it has already normalized back to just the high negative levels. So I'm not too sure if any confirmation will drive another reaction in the market when it's already been so risk off as well, especially with the fact that the Trump administration, they can say one thing but then do another thing 24 hours later. So in addition to headline fatigue, I guess the market's it makes more sense to be risk off when the trading environment can change on a day-to-day or a week-to-week basis. So perhaps it's best to hold off the risk or to react to something that's more sustainable, or there's more confidence to add trades to.
Yeah. Okay, so that's a good time to cut to the officials. So hi guys, what do you make of all the events then?
Yeah, thank you. Been a really interesting week. Thought it'd be useful to go through the OPEC stuff and touch on the OSPs and also the upcoming allocations to China, because I think all three really should be considered together. So yeah, on Saturday, as people have discussed, we got a 411,000 barrel unwind, at least on paper. But I think it's really important to draw that distinction between what's actual supply and what's a paper unwind that's just going to result in more compliance. In our view, much of that unwind is really only going to reflect an improvement in compliance as opposed to bringing additional barrels to market. Many OPEC members have been overproducing, as we've been discussing. Iraq are at like 4.7 to 4.8, ahead of a quota of only just above 4 million barrels per day. So they're kind of at max, and the overproducers have basically been pumping at will almost, and not adhering to those OPEC quotas. So unwind there is probably unlikely to materialize in more supply. But yeah, the Saudis is going to be the focus, I think, here. They've been pretty compliant. In fact, they've been underproducing based on their quota. They're at about 8.8 million barrels per day compared to a quota of 9. So there are fears that an acceleration in this unwind schedule would bring more barrels to market from the Saudis who've been compliant. But I don't know, that the 160 kbd they received, given the OSPs, and the Saudis still seem reluctant to launch a full-blown offensive. The recent hike to Asia was much softer than mechanically implied. So like mechanically implied 25 cents high, and then we got like a 20 cents hike. So yeah, it's softer, but a lot of people were suggesting it would be negative for a full-blown price war, and we did not see that. I mean, what did you say?
Yeah, exactly as you say. So the change in the Dubai physical premium from the March into April trading would have implied a hike to Saudi OSPs to Asia of about 25 cents.
For Saudi Light, yeah.
Exactly, for Saudi Light. and instead they moved it up by 20 cents.
Yeah.
So if they were going to launch, as you say, a full-blown price war, you would expect them to lower their prices, really fight for that market share by making their barrels more competitive on the market.
Yeah.
So you have this kind of mixed signal in that they're increasing their production, relaxing the quota on paper, but then their pricing isn't moving down as hard as people might have hoped or expected. So in that way, I don't think we're gearing up for a full-blown price war just yet.
Yeah. I mean, they have been pretty consistently underpricing their OSPs, at least on a mechanical basis. We had a similar situation. I think it was 20 cents lower than mechanical implied last month.
Yeah.
So, you know, and that's additional, right? That does compound.
Yeah.
But yeah, it certainly wasn't as aggressive move as we were expecting, as many were expecting if the price was to materialize.
I think the bigger narrative now is the kind of the compliance narrative, the argument that the Saudis are trying to push these Iraq's, Kazakhstan's, etc., into line, saying basically get back to your quota or you could face consequences, rather than necessarily a market share battle or a price war, which was kind of the narrative that emerged last week before the meeting. But the OSPs have really been a turning point.
I mean, it was also interesting when they brought the meeting forward, right? So the meeting was initially scheduled for Monday, but then it was brought forward for Saturday, and then, you know, we heard that there were discussions on Friday before the meeting. There's clearly, I mean, and that's nothing new, right? There's clearly a lot of conflict within the group. On the compensation schedule front, they've been kind to the UAE. Less kind to Iran and Kazakhstan. But it'll be interesting to see how that develops. I personally don't expect any of the overproducers to come down to quota. I think it's going to be the other way around. I think quota is going to come up to them slowly. But yeah, it should be interesting to see. I mean, the next stage of kind of the Dubai cycle will be allocations to China, and like what are we hearing?
Yeah, so
on that front.
Well, soon the Saudi Aramco they'll release their allocation to Chinese refiners, and last month was the biggest we've seen since we started tracking them. As the officials, it was around 48 million barrels of supply to these Chinese refiners. And we've heard some rumors that the likes of PetroChina this month are going to get an even bigger quota, so even bigger allocation. So this could be indicative of, again, the Saudis pushing a bit towards getting a market share narrative going, but holding back from an outright price.
I mean, this is also really important because, you know, for a long time the kind of macro narrative has been weakness in China, but now we're starting to see pretty decent allocations there. We've seen like from our the Onyx indicative margins. Margins are still okay.
Still pretty good, yeah.
And now, just today, we got some more monetary stimulus. We had a cut to the reserve requirement ratio, and also some like 800 billion yuan in equity stimulus as well.
They're throwing the kitchen sink at it in China.
And that's only going to continue. They're coming off a really strong first quarter, 5.4% GDP growth. So I think, you know, it's an interesting point from that perspective that there is demand for Dubai grades in Asia.
All right, guys, that's a great summary as always. And you sound like you know what you're talking about, which is great. But the only thing I had to add actually was just a lot has been said about the narrative, and you know, we know the Saudis in particular, you know, that they think very deeply about their moves, both in what they say and what they do, and they know things are very scrutinized, and there's always a lot of nuances to it. One thing I did also read that was interesting was, you know, because it did seem weird that the OPEC in the middle of the tariff war or tariff announcements at peak volatility, they announced their production increase. That was very unexpected given the, you know, this big price decline. And it's since emerged, I think Trump said a few days ago, if not yesterday, that look, now is a good time to negotiate with Russia because the oil prices are lower. And actually, he said a while back, look, Saudis or the OPEC are part of the reason why this war has been going on. They need to take responsibility for why the war is prolonged, because they have kept production tight and they've kept prices high. So it does speak to possibly, and we'll never know, of course, but it does speak to possibly there was these bilateral discussions with Trump and Saudi, and they did agree, okay, we will get the price down, and we'll agree to be more measured with this whilst whilst the war is ongoing, and then we'll take it from there. So I wonder if that's going on, just to add to what you were saying on a narrative basis. Don't know if you've got anything to add there, but I thought that was interesting.
Yeah, so the Russia story is one of the budget as well. Obviously, the Kremlin came out and said, "Oh, national interests come before oil prices," but there is certainly some pressure on Russia from the US and the war that has been since Trump came in, really. And then I think the increasing fragmentation that we're seeing between OPEC members is an important aspect of this negotiation. But yeah, I don't particularly expect a massive price war to come out of this. I think the Saudis are frustrated, but it wouldn't be in their interest to crash the market any further.
I think the Saudis, they have more capacity for a price war, to be honest. They can issue debt pretty comfortably. Iraq, Kazakhstan, not so much. Russia, definitely not so much. So I think that they do hold the cards here, and if they wanted to, they probably could.
Yeah, they could, but I don't think it would be. Yeah, maybe. That's up for debate.
Well, that's what makes a market, right? You have to, if people disagree, that's what makes a market. But thanks, guys. And we'll leave it there. Back to the studio then. So yeah, guys, I think off the back of what they're saying, it was coming to mind for me is maybe, if anything, the market's now rebounding almost too much. Okay, it wasn't as bearish as people expected, full-blown price war, but it's still, OPEC and Saudis are not in a position where they can cut much more from what they have. They've cut all the way to the bone, right? We had that graph last week, kind of 34-ish down to 28, 29. If they come back 400,000 barrels a day again, that's really getting to the limit. We know this, right? We know that the other countries are screaming to overproduce or produce more. There's a lot of conflict, and I think what I'm getting at is speaking about the Brent Dubai trade again, because this has been a consistent theme for us from a trading perspective in the last few weeks. It might have rebounded quite a bit, like you were saying, Harry, but I don't think you want to be getting caught short here or thinking the trend's reversed, because we're talking about structural unwind that, maybe we could go back to where we were, but that was you see what I'm saying? Like it just feels like going forward, we've exacerbated as much as we can. So I think almost the market's getting a bit too far the other way, if anything.
Yeah. And we never would expect it to just go in a straight line, and I think you would be the same. The trade, especially on the deferred stuff, where you can expect further increases in production. Even if that's not like loads of net barrels on the market, but you're still putting pressure on that Dubai benchmark. So yeah, I think you definitely don't want to get caught short, because unless you think that it's just going to go completely back to what it was, it doesn't really seem like a great asymmetry to being short. So it's still valid what we discussed last week. The asymmetry is 100% to the upside. I don't think you can make the argument that the risk reward to being short is anything apart from a quick contrarian trade, just kind of trading against the flow of it. But in terms of a long-term structural trade, especially on the back end stuff, it still seems like there's way more room to go higher.
Yeah, so I think if we extrapolate that to Brent flat price as well, I mean, it's up to 63 this morning. That's quite a big rally from the lows on Sunday night, and we could get a bit of momentum here. And look, we were bullish last week, and we could see the momentum was very strong. And we thought if the CTAs get involved here, this could really push things higher. But ultimately, you're running out of room from a narrative perspective the higher it gets. And also when you get close to 70, that seems to be where the inflation argument comes back in as well. So you're kind of capped there. So I would extrapolate your asymmetry argument to Brent flat price as well, actually, and say, look, if you're looking to get long here, the market's kind of shown it's not got a lot of room, and unless you do get the CTA unwind. I guess that's the only thing I can really see. But I imagine that would be short-lived, because you get quite a lot of sellers being like, look, on the balance of how things are going and the production that's now back online and probably continue to, I don't want to be short here. So again, the narrative being, let's go back to the industry discussion about what the industry is probably looking at. the Brent time spreads have started to perform again. That actually makes a bit more sense because refiners are coming out of maintenance. In May, historically, has always been a really strong month for crude and dated Brent because the Chinese are coming out. They stack up their orders. There's generally good buying out of maintenance in both Europe and Asia. So I think it makes sense that we've probably found a low here temporarily in the spot market. And it's looking like it should rally. And it should rally whilst the refinery margins stay strong. So I think that compression of selling product prices versus buying dated Brent, that kind of refinery margin, real for refinery margin, I think that has to compress. But anyway, we talked about that a lot. Let's now talk about how the hedge funds are getting on. This is the hedge fund watch.
Of course. So on the hedge fund watch, key summary was that they have seemingly rebounded in April from a tough start to the year, and Citadel flagship fund erased losses in the year to date, whilst the tactical trading fund up 1.9% in April, equities up 2.2%. More on the oil side of things, so managed money positioning in Brent has been very much on the neutral side, so quite risk off since the start of the year, kind of hesitant to put positions back on, yet they're not, the net length is much more lower than the start of the year, whereas in RBOB gasoline, I think Harry was mentioning that they have been doing quite well.
Yeah, Greg,
well.
So my sort of standout from the hedge funds this week would probably be RBOB to heat. That thing's rallied pretty like almost $3, I think, on the week in the front end. Are we still of the opinion that the hedge funds have been riding this trade on the long side, RBOB to heat?
Yeah, I think it's one of those macro theme trades, if you like, that makes sense for the year, and it's one of those trades you just have on for quite some time. But of course, as it's in the money, things can't just endlessly go up. So yeah, if there's profit taking now, that would make sense. But having said that, gasoline driving season around the corner, or pretty much coming here. We're trading it now to some extent, and it's looking relatively bullish. And it just doesn't make sense for the diesel market to outperform in an oversupplied market, OPEC heavy crude coming back online, and recessionary fears. So I think it all continues to make sense, and it's probably quite a nice. It's probably not an overcrowded trade because the volumes that are on long RBOB versus heating or long RBOB versus distillates, it's going to be completely overwhelmed by the volume on the individual cracks. So I don't think there's that much risk of it becoming an oversaturated trade, just purely of the net. You see what I'm getting at, right? The differential won't hold as much as the two individual product cracks. So I think it's a relatively safe trade still. As you say, it's performed, and maybe you continue to ride that trade. But I did see, gasoline cracks have taken a bit of a recent beating, and maybe that is profit taking. But it's pretty hard to get the statistics from this from the CFD, right? So we're kind of on the basis of flows and what we're seeing in kind of the swap markets would be where we're coming from, right? Yeah.
What else we got, Vincent?
So something else I was wanted to mention was that at least the Onyx's CDA model was showing that the CDAs were getting very much short over the past week, riding the sell-off. So in Brent, at least, their positions are nearly max short, only beaten by the sell-off in October last year. So yeah, hedge funds are nearly max short, which means that on the bullish scenario, there's a lot of room, there's a lot of bullish risk for them to deploy back into the market. So in a sense, that also means that they're kind of saturated, overcrowded on the sell side. So that's an interesting thing to note.
Okay, let's turn to more specific trades and where people have made money. This is the gold rush.
Yep. On the gold rush, in addition to what Harry's mentioning, the RBOB versus heating oil trade, I wanted to mention that in fuel oil, players have still been doing quite well. Pointing at the 380 spread, so July versus August, that's the strongest part of the curve where it's the most backwardated, as we can see on this chart here. It's been kind of risen since from the start of April, $8 to highs of $13 per metric ton. So that's over the month thing. Although had corrected slightly at the start of the week, our data is showing that the market has very much been making money here. So on a COT dashboard, it's been showing that that the market's been adding around 4 million barrels equivalent to July Augie. And on the first day of this week, there had been a bit more selling that's been seen, but overall the market's been very much in the money. What they attributed, although there was a sell-off on Monday, this could be said perhaps related to the fact that the market's been overheating, the OPEC news, or the fact that it's been identified that a lot of Chinese players have been coming in to buy the 380 market, and they were on holiday for over the past week. So because of this lower liquidity conditions, that gave a bit more room for selling. But overall, players have done very well in the fuel oil, high sulfur fuel oil, especially the 380 market, very much gearing up for summer demand, which this really lines up with the time where the prices are seasonally the strongest.
Yeah, it's definitely interesting, the relentlessness of this fuel market. Kind of just buying on dips has worked, right? We thought the initial huge rally was just a squeeze, or it was like basically catching the market unawares, and it's just continued to be strong, and you're getting these big moves. But at least this time we feel like the markets, as you've been saying, are actually making money out of this. We've had the initial first big move upwards. I think the majority of the market got caught out, but now we're kind of really capturing this strength. And I guess the other thing that we mentioned before is so much consumer buying when flat price was dipping aggressively with the tariffs. And I imagine that flow is still kind of tapering in. Definitely a lot of consumer confidence from the hedging side, which is adding a lot of buy orders, and therefore supporting the market. So I guess it does kind of make sense. But I guess we can look at the fuel oil market on a crack basis.
Yeah. So
Yep,
this
on
is
the
the
screen
crack.
now.
Yeah. So this is the Sing June crack, is it?
380.
So,
M1.
yeah. So this is June. So yeah, I mean, we're still in positive territory at the end of the day. I mean, it's just very, very, very strong, and you can see how aggressive the move was, kind of basically all the way back to the beginning of the year. And yeah, we've had some like decent dips, or it's rolled down to a weaker level, just all the way back up, and to be consistently in the positive levels, like this is really like quite dramatic stuff, because we talk about refiners being able to make money from a waste product like fuel oil being really good for refinery runs, but to be so sustainably high is quite a big deal. So if there really is an oversupply of crude, then we should really be seeing a lag effect as the refiners come out of maintenance and are running, not hopefully, we expect very hard because of how much profit is in the margin. Then there is a lag effect because the supply needs to be generated over a few weeks, a month, but that supply will come in heavy. And look, obviously the physical and the paper, the relationship is obviously not always one-to-one at all, and there will be traders who want to keep this elevated and are able to do so, but at some point they've made their money, and keeping it at positive levels and those spreads as high as they are when you're getting flooded with fuel oil from the refiners, that has a long way to go down, right? But it's fascinating to see it holding up. And I would probably wage that there aren't that many traders out there that want to be short that crack or short the time spreads, because A, they got so burnt on it earlier on in the year, but B, it's been sustainably strong. It's not a flash in the pan, and who wants to go against the entire market basically? So I think we did get some selling flow in off the back of the OPEC news, but minuscule relative to the large scale of things. So I guess if you are a contrarian trader and you are wanting to get short this, and you've got a flat book, it's all well and good saying it's a good sell, but if you've been trying to sell it and been burnt, it's quite a hard thing to say. But fresh book, it still looks, right, Harry, like you want to be getting short here. And I think looking for the dislocations, maybe it's not in the front, maybe that's still got a while to go whilst the refineries bring some of the supply online and start to hammer the premiums in the prompt, the physical premiums in the prompt. But maybe it's a back end crack, or something's got to be out of whack here. Don't know if you've got thoughts on that.
Yeah. Well, like you were saying, in terms of like how to express, what are the good trades at the moment, and we, not that we necessarily think that it's a no-brainer but at all. But in terms of selling the refinery margins, if you've got a positive 380 crack and you want to short a refinery margin, you're definitely going to want exposure to that 380 crack, because that's like, we always say like the refinery hedging, like refiners love hedging the waste products because they don't, it's not about making money on them. It's just about not losing money. And if you can lock in a positive fuel oil crack when you're on a margin hedging program, you're going to be selling the selling the arse out of it, because it's not the kind of thing you would want to look back on and be like, fuck, we didn't sell fuel oil cracks when they were positive. You're right.
Sorry, I was just going to say the only problem is just how backwardated the spreads are, which means the prompt can sustain in dislocation for a while, right? And that's that you don't want to be shorting something that's dislocated, because it's kind of giving you the signal that it's been pushed out of whack for some short-term reason, right? Oil's been taken out of the region, a hell of a lot of buyers are coming at once, whatever it is. But it's the sustained things. It's actually a roll-up trade at the moment. People are actually buying dips and rolling it up. But what I'm saying is like, if you look at this and what I want to be selling it on a kind of long-term oversupply basis, where you'd be selling is probably down the curve, and maybe the levels don't look that attractive. So Vincent, could you get out the Q4? Maybe the Q4 barge crack, like 3.5%, the Europe fuel oil crack. I think that would be interesting.
Yeah, let's
that is a good point, actually. I guess we were talking about June here, and that's a very prompt month to be hedging refinery output. So you're right. It's you're probably looking at the crack rolls and thinking, and the crack rolls being the kind of the front versus the back 380 cracks, and if they're kind of even like -2, -3, which is historically still very high, you're probably thinking like, well, why wouldn't I roll it up rather than sell it?
Yeah, we have the Q4 on right now.
So this is a Q4 barge crack, right?
Q4 barge crack, which has from March -9, April -8-ish. So it's kind of rallied. It's kind of
more reasonable levels, right? I mean, I would still just eyeballing the chart, not knowing anything, and coming into the market fresh from like a holiday or something. I would still look at these levels and think, that's a good sell. If OPEC are coming back online, more heavy crude, more OPEC crude, the demand's going down, I'd want to be selling this at -7 for sure. But just on the backdrop of how long does it last? What's going on in the prompt? But I like Q4 because if we're saying that the prompt fuel oil market is very strong and it's rolling down weaker. That's how forward curves work, right? You get a lot of strength. The back end of the curve tends to be a bit weaker. But then people like to, if they believe that the market's going to last, they'll buy the low price and just waiting for it to roll up. If you think the market's in a long-term bull market. And I think we're skipping to Q4 almost subconsciously, right? Because we know that Q3 is the peak demand time. We think gasoline, tends to be very strong. If you're bullish in markets, it tends to be around Q3, a very generic thing to say, but that's how it's worked out in the past few years or so. So you kind of want to let that breathe and then sell Q4, and that tends to be when you get this dip as kind of things. The demand basically dips, and the euphoria of Q3 and the positions roll off. But getting in at Q4 at -7, and it's kind of starting to trend lower. Could you get the chart back up again? I would say I'd be in a position where you're actually kind of looking at that as a new trend. It's been a few weeks now where it's weakened, so it's trending down. You're not really in a contrarian trade there. You could be selling around -7, 7.10, and having your stop above at the highs, which is -6. That's not a bad trade, right, Harry? I mean, because you could ride that down in a weak market, at least a few dollars per barrel.
Yeah, I mean, you can even see from the chart, back in Feb, like between Feb and March, it was down to -10. So there's no reason why it wouldn't just drift back down there like pretty easily, really. You'd obviously want to be watching out for if the Q3 margins are good and the refiners just are slamming utilization as high as possible. You do run the risk of outages, and that can obviously turn things pretty quickly. But there's no reason why this wouldn't move down, as the market starts to fade, and even if those Q3 margins start to fade, then people are going to start looking at Q4 being like, oh, has this bond been dragged up as well? is this actually the better sell than Q3?
Yeah. Well, let's look at the refinery margin a bit later. We've got some stuff we need to rattle through. Is there anything else, Vincent, on the gold rush that we want to point out?
No, nothing.
EBOB cracks, but we talk about that every week.
Yeah, we do. And maybe naphtha cracks starting to finally weaken. That's down 50 cents or so after a decent rally and catching people unawares, but nothing major there. So let's move to where people have lost money then, and this is the Widowmaker.
Yeah, so on the Widowmaker side, I wanted to point out the naphtha crack as we got on the screen here. So really very much rallied from so looking at the June crack from -4 to above -2. That was just off the back of the crude sell-off. So almost rallied around 1-to-1. How much crude sold off was how much naphtha cracks rallied, and I always heard that the rally kind of caught a lot of shorts offside, especially with crude being weaker, gasoline demand, gas nap, blending hedging, as well as hearing that some refineries had overhedged on the south side, so unwinding their short positions, or if that led to a spike on the long side. And on the dashboard, it was showing that the average short entry price was around just above -$4. So in this sense, shorts have been out of the money in the naphtha crack. This is where we identify as there were a lot of short covering flows that drove this rally. But recently it's been more, recently it's kind of come off by a bit.
Yeah, it's an interesting one because I guess we've been so high for a while, and we'd actually been calling for a long-term sell in Q3 MOPJ crack, right? And I think with a pretty wide stop, we were suggesting a few weeks back. So you'd be okay if you have a long-term kind of wide stop trade on, but ultimately, this is the classic. This is when people get burned. This is why we call it the Widowmaker, because it's unexpected, and there wasn't much to signal that naphtha would have a decent rally, right? I mean, as you say, short covering, maybe oversaturation on the sell side is one thing, but I think the kind of the events of recent events have just made things difficult. People trading the crack, remember, naphtha versus Brent, it's a relative value thing. You can easily have a strong naphtha market and a weak product crack, and vice versa. So sometimes it's a dangerous trade if you're expecting it to go 1-to-1 with the market trend. But having said that, we think it's probably been led by the naphtha time spreads, right? They've had decent strength, decent movement into the settlement. So the physical players, the trade houses, probably been enjoying. So it's kind of like a gold rush for them on the time spreads, but we also know the market's been short the cracks, funny enough. So that kind of dislocation is kind of makes sense why the market is kind of being caught a little bit unawares, but nothing too drastic. Some short covering flows, but I would say the market generally has stayed in that trade. And as it's kind of come back off, they're starting to be probably more confident again. The market's starting to be okay. And I still think, long-term picture, there's been signals in the headlines that the Iran deal is genuinely possible. That would be very bearish for condensate and naphtha supply. The naphtha market is historically very sensitive to the Iranian output. So just generically, that in itself is looming on the naphtha market, and I guess the general theme of oversupply in the market. So yeah, and refinery margins being strong. Naphtha and fuel, we keep saying, right, are the waste products, and they should weaken in an oversupplied market. So I think this is how the market's thinking. So they like to be short this, but they're going to get burnt on, if the market's going to be so short, it's going to get burnt on short covering flows sporadically and volatility. So not overly surprising. But is there anything else?
I think this for this week, the thing that stood out the most was the naphtha crack. Otherwise, potentially Brent to buy on the way up.
Yeah,
I suppose caught.
Yeah, I would say that has to be said, because the volatility is it's unusual, right? Like to get, I think, just in a couple of days on people getting more high conviction with the OPEC market, 50, 60 cents in a quarterly Brent to buy and $1.50 in the prompt in such a short period of time, and so one directional. Like our trader was saying, it's very unusual to get such consistent Brent to buy overnight So you know, have a bullish move during the day and then overnight gaps up, bullish move during the day, overnight gaps up. That was like 4 or 5 sessions it did that, which is very unusual and does very much speak to a short market, and the data says it. So you do have to say, I know we've kind of gone on about a lot, but that has been a winner maker for 1 or 2 large trade houses, and that has to be said. Okay, so let's get a bit more into the minutia. This is the deep dive.
On to the deep dive. We've got we're still on fuel oil. So on the June 380 East-West, which trends had been particularly interesting here. So a couple of weeks ago on the show was discussed that the June-July 380 East-West box was something to watch. We've talked about it plenty of times, how strong the Asian high sulfur fuel oil market was, 380 time spreads and all of that. And it was really very much 380, the Asian market driving the strength. However, on the top right hand of the chart, you could see that within April, there was a bit of a volatility spike. Prices went up. $20 came off to 14 and went back up to 21 again. During this time, the selling it was seen was focused in June. So not only did the outright come off, the East-West box came down from $8 to $2. However, on the outright on the June, there was another rally back up again. But why we made it the deep dive was particularly interesting observation. As prices went down, open interest in the East-West went up. However, as prices rallied, the open interest still stagnated. So in a sense, it kind of shows that the bullish momentum is weakening. And on the bottom hand side, this is the chart of the RSI, Relative Strength Index, indicating momentum of the trend. Basically, in simple terms, it showing that even though prices have rallied back up again, this bullish momentum isn't as strong as before, which could be a precursor to a bit more weakness to come. And more on that is also shorts have been out of the money, whereas longs have defended their positions. So it's something interesting to watch as well. I think the rally this time was a bit more short covering, whereas the sell-off was more longs defending and like shorts entering new positions.
Okay, let's get forward looking now that we've had like a decent summary of everything. This is the crystal ball. So as always, let's start with the Onyx beta, which is looking at Brent flat price, the front time spread in Brent. Then we've got the European gasoline product crack and the Sing distillate crack now we're doing. So this is just a binary call up or down, and we've been tracking it, plus 1 point for a market call correct, week on week, and -1 if you've caught it wrong. But yeah, it's been actually, always a coin flip when it comes to Brent flat price. And, if we were that good at predicting it, we'd be printing money all day, every day. And obviously things are hard to do on a week to week basis because there's so much volatility sometimes in between. But generally speaking, it's been a relatively straightforward market to predict in the last few weeks with all that's been going on. Easy to say, but I think now we're kind of in a bit more of an uncertain time, I would say, right, guys? So if we start with the outright price, what are we thinking, Brent flat price?
I mean, I think on balance, I would still lean towards the bearish side on outright flat price. I don't have a huge amount of conviction or reasoning behind it that's that different from last week. I think the good refinery margins are going to manifest in the Brent spread, so I'd still be bullish the Brent spreads. But the outright price, I think, I don't know. Yeah, I still just think it's just risk to the downside. I mean, you saw that open below 60 on Monday, and then you've had a pretty dramatic spike back, and kind of feel like that move's maybe a bit overdone on the way back now. So yeah, on balance, gun to my head, flip the coin, whatever we call it. Yeah, I think I'll be bearish. But then I would still be bullish the time spread.
Yeah, I mean,
on my
we've
side,
been holding that narrative. Sorry, just before you speak, Vincent, because I agree with you, Harry. Like, we need to basically look at Brent time spread and think the spot market should show signs of strength, right? It's had a bit of a beating, that time spread. It's gone down quite a bit from the highs after the whole situation. We had a relatively strong Brent expiry last month, and certainly that month was very strong at times, all the way up to 120-ish. So at one point, so the time spread at like 41, 42. I think the trend is still good, and I think there's a few reasons to be bullish the spot market with refinery margins again, and refiners coming out of maintenance, and generally kind of stability. But my theme here is the lower volatility. I think if there is a trade in the outright flat price, and that's a good thing about doing options, right? You don't just have to have a view directionally, as you say, Harry. Like if you've got a gun to your head and it's hard to call, well, your view might not just be direction. I think my view would be low volatility. I think you said it well at the beginning of the podcast. Headline fatigue and kind of everything. Everything's been very drawn out and played out. We're now kind of moved away, and I don't think there's a lot that can shock this market. And there's been a lot of positioning in and out. So I would say, if you could, how do you sell volatility? You can outright sell calls, sell puts, and you can do it like that. Very risky, of course. Or you can deploy it in your trading strategy. You can be taking like a 3-day or 5-day range, and you can be just drawing your lines on the charts and starting to look at it on a technical basis, selling as you get towards the recent highs and having conviction there, and buying obviously the dips and narrowing in the range and just trying to compress it that way. That is effectively selling volatility. It's basically mean reversion trading. And that would be if I had to trade Brent flat price right now, that's how I'd be looking to do it. And I say all that to lay out Vincent, the technical analysis wizard, geek in the seat, fortune spent on his exams that he's about to fail. So
I was going to say, we don't know he's a wizard yet because he might have fucked it.
He spelled it, yeah. So that's stay tuned for next week when we find out if Vincent's failed or not. But it might be one of those ones where he gets the exam results, but he never lets his parents know, right? He throws it away.
Yeah.
But anyway, Vincent, if we can get up the technical chart on Brent flat price and talk it through, and let us know what your opinion is for this week.
Yeah, of course. So I've got the technical charts up for Brent futures rolling M1. So as we can see, there has been a bounce back up this week off the lows, opening below $60, but 3 days in a row of bullish candles. We do see a bullish reversal pattern from the lows. Bearish momentum's also weakening as well. I point out a tentative formation called a descending triangle, which indicates that volatility is indeed, as you guys say, is dying down a bit. But what it also means is that prices are currently trending within this triangle. But as soon as it either breaks out above or below the lines, there could be a volatility breakout there. So if that happens, if traders are quick to react, then they can catch either the bullish or bearish trend going in either direction. So on a longer term, we could say the support is around the $60 or earlier lows around $59. That's where prices could find support. But on the upside, recent highs of around $68, that'd be a key resistance level, as you can see on the white dotted line. So on balance, I am a bit more bearish in the short term. Prices could come up down to the low 60s based on both technical perspective, but also the market does seem to be wanting to be a bit more bearish. The rally this week has been a bit overdone. So yeah, very much on the downsides.
Okay. Well, just to be different, I'm going to say it's going to keep trending up and find a support level in the next week, which I think from the chart looks to be, if you bring it down from the 68 level to more like 67, 66, and then that range kind of compressing between 61, 68. And then you start, the market likes to build in like psychological levels, right? Support levels either side. And I think 60 is obviously, like it was 70 all last year, it'll be probably 60 for a while now. Given that is, nothing's flooding back right now. We've stabilized after, remember, we've had like a $15 move downwards from the beginning of the year. So there's been a lot that's changed. So that would be my call. And on the Brent time spread, yeah, I'm kind of with Harry. I think the spot markets should have, well, it's always been strong. It's had weakness temporarily. And the interesting thing about the spot market and how it's priced and how it prices on expiry and how it prices in the dated Brent contracts. They're a niche trade, but you can trade them and they're exciting. And if you've got, balls of steel, but ultimately one cargo that, it prices to a fixed number of cargoes, or at least fix a region of cargoes. And just one of them can actually weaken the print quite considerably. And that's the physical diff. That's the same as a time spread. That's the same as the differentials of data Brent versus Brent. There's all these contracts that rely so heavily on what the physical spot premium does, and that can weaken, hugely just with one barrel overhung. And I think that's what's happened in the last week with bearish sentiment, but also genuinely kind of a couple of excess cargoes out on the limb, and it can't be absorbed. It can bring the whole spot premium all the way down. But I think that now comes back up. Those get absorbed as refiners are back and as kind of a bullish momentum for at least a short-term period is there. So I think that drags up the time spread. I think there'll also be a bit of caution because we went from about 35 cents on June-July Brent time spread all the way up to $1.20. And I think there was a fair amount of bullish traders into expiry. And I think, like the North Sea cleverly does, the North Sea traders, they get a good sense of when the market's getting a bit overhyped, because there's only a few of them who really take on expiry. You're talking like 3 or 4 big players in expiry. I would have seen, a wider market who's kind of tourists into this trade and tourists into expiry kind of being long and probably thinking, I wouldn't mind taking the other side of this. There's an asymmetric risk reward here, being short around the 90 to plus $1.20 level. And it did look like a few players took it on. And look, it didn't weaken that much, but it weakened enough to kind of frustrate kind of really bullish traders. So that being the case, now we're a few weeks from the next expiry for July Aug, but we're still at 42 cents. So I would say, given the market's probably a bit more tentative, in a way that's good. It can breathe, and there isn't going to be excess positioning either way. So I would say it kind of drifts up to like potentially the 70 levels, maybe not in a week, but in the next couple of weeks. Okay, so moving to the EBOB crack, the European gasoline versus Brent. So this has been on a bullish momentum probably all year, right? It's been a standout trade for us to call, bullish, and it's behaved in a relatively orderly fashion. What's the theme? I guess it was that we were getting more conviction, and we felt that now was the kind of time where saturation was probably coming in. There's probably too many people now piling into Q3, which does tend to happen. People love to be long summer gasoline, and we felt like it was actually under traded with the volatility of the tariffs early on in the year, and that was maybe allowed it to be on a bull run. But now I guess we did say last week it's hit that saturation point, and I guess I would probably maintain that. And again, with refinery margins being strong, and I think a lower volatility market, I think it continues to compress, and I would be bearish. I don't know how you guys feel.
Yeah, bit of a tough one to call. I mean, especially as you had another move up on Monday and Tuesday. I mean, it's not something that you would have massive conviction going short on, but yeah, I think just with the recent move up, it is probably, in the short term due a bit of a correction. So I would concur with you.
Yeah. What about you, Vincent?
Yeah, on my side, I think although there's merits to be short in the short term, I think on the longer term side, the trend is still very much bullish, and I don't see a reason to go counter against that unless there's significantly bearish news on the macro side or once hedge funds start unwinding. But I think potentially with continued Dangote refinery issues with other various potential refinery outages, there's potential for further spikes, further bullish momentum going forward. And actually on the seasonal chart here, if you guys can see, the white line is 2025 M1 EBOB crack. So on a historical basis, there's still more room for rallying. Currently, it's a very orderly upwards trend, and personally, I'm not going to go against that. So I'd still say I'm bullish until concrete news or concrete technicals that show that I need to reverse or take profits.
All right.
So trend is your
the peak
friend.
2022 was okay. Obviously, that's huge, 48. But we're a more normal kind of high level. Where would you put it out then? Just if you the seasonal chart.
On the seasonal
So,
chart,
yeah,
at 16.
But if you discount 2022, I mean, we're not too far away from the 2023 levels. And remember, that was still an abnormal market. So I hear what you're saying, but I think if you normalize and take out the wings, if you like, I think we are approaching towards the higher levels. 17. Yeah, look, I mean, I hear your point, and that's again the whole point of the market, right? People have different opinions. Do we have the open interest though? Could you get that up on the dashboard?
Yep.
It's not to say that we think that this is like the absolute top of the market and everything is going to sell off. It's just in the interest of this segment, we're trying to kind of finesse it a little bit into thinking like what might happen over the next week. And when you've had a big move up and a lot of people piling in, I think
that's the general thing. It's maybe a bit exhausted, and but Harry, I would say, like, again, it's kind of been my thinking as we've been talking this whole time. Like, the compression of the refinery margins has generally got to come into focus now. And I think as the market's normalizing and as there's real supply back, and there isn't really a shock here for, we haven't, yes, I hear what Vincent's saying, the Dangote refinery issues, and there could be more, but the refiners have also been saying they're not going to run full, like, head blown. And that means, and I don't know about the weather forecast, to be fair. We'll probably bring that in next week. As we get into summer months, the weather reporting does become very important because that can very much lead to operational issues. So we need to be aware of that. But there doesn't seem to be anything on the horizon that would suggest that we're ready for a shock. But look, I mean, that's the whole point of this discussion. But Vincent, have you got the open interest up?
Yeah, so this is the open interest for July EBOB crack. So it is above the 5-year average, but it has very much stagnated over the course of April. And there's been more selling flows in recent times. So to your point, I guess it could be at a point where the markets is a bit more exhausted. They have already have added length into it and they're just riding out the trends. So perhaps there's more bullish room to come in, but it also seems that
and the state of the
there's
market,
a bit of hesitation. Yeah, long short still it's more bullish, but the past week there's been much more selling.
That's interesting. So if there's been selling and the volatility's gone up, it's kind of indicative of basically good profit taking, right? And that's quite healthy for the market, I would say. So yeah, I take your point. So that means there's probably more room in this if the market is stabilizing itself. Yeah, maybe got over ahead of itself, but if the market is still stable with that much selling, then like fair enough. So I guess you take the bullish view, me and Harry the bearish, and then distillate cracks. I think this is the interesting one for me because it just, again, thinking about a normalization trade, things haven't really got back to normal since even 2022. I mean, there was such a big blowout and all the differentials, product cracks and all that. And then 2023 was more normal, 2024 even more. But still, we're still at levels which I don't think are historically normal at all. When I've been trading in the past and we've been OPEC around 34 million barrels per day, and I guess that's the key one, right? We've had 5 or 6 million barrels per day less of OPEC crude being replaced with light sweet crude, which speaks more to that for gasoline, and less diesel, less fuel oil. It makes sense that there's been that shift in product cracks, but to have fuel cracks so positive and to have diesel cracks so positive, normal levels like $8-9, and we're in like the high teens, right? I have to just check that. But to me, again, that just feels like if there's going to be demand destruction, there's going to be a general weaker overhang in bearish sentiment, then how does diesel remain strong? And as we get more macro data coming out, that's the one that feels vulnerable to me. So I kind of have to maintain a bearish view on that as well.
Yeah, I think I still feel like gasoline would even outperform diesel. So I think if I'm going to be bearish gasoline, then I'm going to have to be bearish diesel as well. And especially for the points you just made. So yeah, I'd be bearish. Are we saying the Sing distillate crack? I mean, it doesn't really matter, but just for the charts. But
yeah.
On the charts.
But yeah, I'll be bearish the diesel cracks. Yep.
Yeah, similarly, I'm quite bearish as well. It's just that there's not much.
Have you got the chart?
Not much. Yeah, the charts. Yeah, the charts up. Got the European low sulfur gas oil swap crack. So prices have been very much like low volatility, range bound between like $17 to $18 over the past 2 months, really. Just very range bound, low volatility, not much going on, and I really don't see, unless there's geopolitical events coming up, I don't see too much upside for the gas oil crack. It's more to the downside with macroeconomic concerns. So if anything, but overall fairly neutral, but if I had to choose one, be more bearish.
Yeah, and I guess if you were looking to trade these, we'd be saying, look, the Brent flat price, I like the low volatility or lowering volatility trade. I think that's basically buying and selling within a tighter range, kind of $4 or $5 range between 61 and 66. That would make sense to me. That kind of trading strategy for the next week. The gasoline crack and the diesel crack. Well, sorry, let's start with the distillate crack. It's trending down. I would just be putting on a sell side entry and having the stop, as you said, quite wide, like above 18, and I'd be carrying that for the long term, because I think that can compress in a normalization down $4 or $5 easily, and you got quite a nice $2 stop, so $2 to make $5. Kind of risk reward quite nicely there. The hard one is EBOB because it's more contrarian. So if you're going to be short that, you're going to want to split your capital and have a few goes at this and wait until it's in the trend and start scaling in. So that is the harder one. And I guess you have to be relatively high conviction to do that, which I don't think any of us are particularly high conviction being short. But if you had to trade it, that would be how I do it. Sell a portion of your capital and wait for the trend to get higher conviction. And then that leaves the Brent time spread, which I think is just, it's actually bounced back from the lows, like the max bearish sentiment we've had. It's now kind of on a bit of a firm trajectory, and it feels quite solid and low volatility at this low end. So I think just, buying 45s or whatever it is right now, stop probably 10 to 12 cents would be absolutely fine, because anything lower than that and you're already wrong, right? If we bounce back now to the low 30s, that was in peak kind of bearish sentiment mode with OPEC. So I think that's an appropriate stop, and you're looking to make potentially 25, 30, even 40 cents on that. So that's a pretty simple trade as well. Quite like those setups. And that's the Onyx beta. So we can look at a trade after this video. Me and Harry can go into more detail as we did last week. And I think just a bit of a teaser for that, Harry. I mean, I think we like the refinery margin, and we should look at that and maybe isolate one of the cracks in order to short that. But I think the general view is kind of getting into that refinery margin bearish sentiment. So we'll leave it there. Thanks, Vincent. Good luck in your exam results, and Harry. And again, please be on the lookout for the explainers we're doing for the officials. They're doing very well. People seem to be enjoying those, and the trade ideas that me and Harry are doing separate videos, and of course the trading corner as always, Macro Mondays. We're trying to get more and more trader focused. Please, all the feedback you can give is very much appreciated, and really hope you enjoyed it. I've been out of Singapore, and I hope that worked. But I'll be back in the office next week, and I look forward to seeing you there. And thanks again.